Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about Quahu Limited, QH. Quahu has really become the definitive case study in extreme microcap destruction in today's market. We're looking at a company that has seen its value just evaporate. A collapse exceeding 99% from its 52-week adjusted high of, $169.07? And right now it's struggling just to hold that critical $1 minimum bid for NASDAQ compliance.
All that sharp, really brief volatility in late 2025, I'm thinking of that 48% spike on November 12, which, as quickly as it came, it just gave way to this relentless, consistent bearish drift. The data from December 5th is especially telling. The stock closed right at $1, but then it immediately traded up to $114 in after hours on just incredibly thin volume.
Right.
That isn't organic. It just shows how brittle the liquidity is around that psychologically and structurally significant dollar mark.
That brittleness is exactly what brings us to the core tension we need to dissect today. Is this catastrophic devaluation fundamentally the result of an underlying sort of organic failure of Quahu's core delivery business, or, as I would argue, is this primarily an engineered outcome driven by aggressive capital structure manipulation designed for corporate survival at the direct expense of its shareholders? My position is that the structural mechanics, the reverse split, the ATM, the massive share authorization, these are the primary destructive cause of the stock price collapse.
See, I come at it from a different angle. While I fully acknowledge the devastating impact of those structural changes on the equity price, I really believe they are just the most visible symptoms of a business that is fundamentally dying. The operational failure, the complete collapse of gross profitability, that was the true and inevitable driver that forced management's hand into these desperate financial maneuvers. They weren't trying to destroy value. They were just trying to stay solvent.
I see why you emphasize the fundamentals, but the actions taken by management suggest to me an intentional prioritizing of corporate funding over shareholder health. This collapse was engineered. The most aggressive financial restructuring started with that 1-for-90 reverse split, which became effective on August 25, 2025. Now, this move, which was designed purely to regain NASDAQ compliance, was immediately followed, the very next day, by the activation of a $50 million at-the-market, or ATM offering with Ace Sunshine Securities. And that ATM mechanism is the structural death knell here, because it creates this continuous supply overhang. The broker is just authorized to sell new shares into any liquidity event, which effectively caps the stock price and guarantees that reoccurring pop and drop pattern we saw.
That is certainly a powerful mechanism for suppressing the price. I'll grant you that. But we have to ask the question, why was that the only viable path left? The financial maneuvers aren't the cause of the company's distress. They are symptomatic of a business running on fumes. The market is pricing in a terminal failure, which completely nullifies metrics like, the 0.14 times book value. That's a classic indicator of a deep value trap that sophisticated investors now know to ignore. To find the real driver, you have to look at the H1 2025 financial report. The operational reality is it's devastating. Total revenue fell 30.2% year over year to about $158 million. Even worse, the gross profit collapsed by a staggering 83%. Plummeting to a mere $600,000.
Yeah, no one can argue against the severity of an 83% gross profit collapse.
Exactly. And that results in a gross margin of roughly 0.36%. That margin is completely unsustainable. It can't cover basic administrative costs, let alone service debt or invest in technology. So the company was facing delisting, which forced the 1-for-90 split. And the ATM offering, as painful as it is, was the only practical way left to fund operational needs, given the complete evaporation of profitability and the intense capital-heavy competition it faces in that just fiercely competitive Chinese gig economy sector.
I agree the underlying operations are weak.
However, the magnitude of the structural response goes far beyond just necessary survival. The structural death sentence for the stock was cemented at the October 2025 Extraordinary General Meeting. They didn't just authorize more shares, they increased the authorized share capital 20-fold to an astronomical 100 billion shares.
That number is, I admit, undeniably shocking.
It is. This move effectively removes any theoretical ceiling on dilution. It creates a potential dilution risk far exceeding, 9,000% from the current outstanding shares. That scale of authorization isn't about managing a temporary shortfall. It's about guaranteeing that the board can print equity ad infinitum to sustain the enterprise, placing all of the financial burden squarely on the common shareholder.
I understand the shock of that 100 billion authorization, but let's anchor the discussion back to the mechanics of the dilution versus the fundamental erosion. You argue that management's intent was, malicious or predatory towards shareholders. I argue that the severe contraction in the business made this outcome pretty much inevitable. The company is still processing, $157.9 million in top-line revenue, which suggests there's some residual business value there. The ATM and the reverse split, though painful, are a rational, albeit cynical mechanism to prolong the life of the enterprise.
I'm not convinced by that line of reasoning because the specific timing and the execution of the ATM proves an intent to liquidate shareholder value for corporate cash. Think about the sequence. The 1-for-90 split dramatically increased the nominal price per share. That move created immediate, temporary headroom. The ATM was activated immediately afterward, on August 26, 2025. This very specific sequence used that temporary higher price to sell the maximum number of new shares at the most efficient price possible.
They were capitalizing on the regulatory compliance window.
Exactly. They were capitalizing on the artificial price inflation caused by the split, and that subsequent inevitable drift, where the price round trips almost perfectly back down to the $1 floor, that signals a crystal clear priority. Liquidity generation for the corporate coffers is paramount, while operational recovery remains a distant second. They are using the equity price not as a measure of value, but as a mechanism to fund a shrinking, cash-burning operation.
Percent revenue contraction and the utter unviability of that sub 1% margin. If Quojo's fundamentals were strong, if they were generating positive operating cash flow, the market would easily absorb that ATM supply without this permanent price decay. The financial engineering merely accelerates the downward price discovery that the collapsing gross profit guarantees. It is the rational punishment for the fundamental failure. The structure just serves the inevitability of the underlying business erosion.
Okay, I agree that the market is punishing operational failures, but management took steps to fundamentally insulate themselves from that punishment, and that creates agency costs that the market rightly distrusts. Let's shift our focus to corporate control. The October EGM authorized 100 million Class C ordinary shares to LSU Investments Limited, a vehicle controlled directly by the CEO, Leslie Yu, for a paltry consideration of just $10,000.
A token payment for securing control.
Precisely. This action guarantees the CEO absolute voting control, regardless of how much dilution the Class A shareholders face. This creates a massive disconnect between economic ownership and voting power. The agency cost is the market's assessment that management's interest, which is perpetual control and enterprise survival, is now completely decoupled from the minority shareholders' interest, which is maximizing equity value. This insulation validates the market's deepest distrust and drives that pervasive negative sentiment that facilitates the continuous downward repricing.
Well, while the governance structure certainly generates poor market sentiment, the immediate, aggressive downward trend is dominated by technical flows and short seller aggression, which is facilitated by these very structures you're condemning. We saw short interest quintuple between October and mid-November 2025. Bearish traders were keenly aware that the post-split headroom made the stock an irresistible target.
But that's short selling of the dilution.
It's facilitated by the dilution because the ATM provides high, reliable liquidity and daily churn. This gives short sellers a low days to cover metric, often around just 1 day.
and this is key. High liquidity makes the stock a safe shorting target. Traders can enter aggressively, secure in the knowledge they can cover quickly without risking a massive short squeeze. This downward pressure is an independent mechanical force structurally enabled by the ATM, and it severely punishes the stock, irrespective of the CEO's voting structure or the 0.36% margin.
I see why you frame it as a short-selling dynamic, but that still places the blame on the corporate actions designed to create conditions for trading and funding rather than stability. Management was not passive in generating liquidity for the ATM. They were proactive. Consider the narrative pivot in November 2025. The company abruptly announced a partnership with Top Liquidity, pivoting hard into buzzwords like RWA, tokenization, and cross-border blockchain solutions.
A clear shift away from delivery logistics, yeah?
Exactly. For a company whose primary business is managing delivery riders, this was a transparent attempt to inject some kind of synthetic excitement. It was intended to generate a news event and subsequent volatility, a temporary liquidity bubble, which again allowed the ATM sales agent to sell shares efficiently into the rush. This confirms that management is using corporate communication and narrative spin not to address core business issues, but to actively manipulate trading conditions to generate the necessary cash flow to survive.
That's a compelling point regarding management strategy, though I would frame the true reason the price remains grounded by looking at the market microstructure. Regardless of any temporary blockchain excitement, the stock consistently fails to hold gains because of structural phenomena, like dark pool internalization. We frequently see enormous volume, often exceeding the 3-month average of 1.9 million shares, yet the price stays flat or even declines.
Which indicates institutional selling is just overwhelming any retail buying.
Precisely. This means wholesalers are executing retail buy orders off exchange in non-displayed venues, the dark pools, and simultaneously matching those orders against massive institutional or ATM sell orders. This structural absorption mechanism ensures that bullish news or any temporary retail-driven volatility created by the blockchain pivot fails to translate into sustained, visible price appreciation on the public exchanges. It is technical selling pressure rooted in fundamental unviability that dominates the trajectory. And this view is affirmed by sophisticated capital. Institutional filings show a major exodus by September 30th, 2025. Both Renaissance Technologies and Citadel Advisors, two firms synonymous with rigorous quantitative risk assessment, had sold out completely. They agree that the risk-reward profile, driven by the collapsed fundamentals, was simply non-viable.
We have established that the operational failure, specifically the 83% gross profit collapse, is a massive headwind that justifies a low valuation. But I must reiterate my central thesis. The systematic destruction of shareholder value beyond that initial collapse comes from the mechanical processes put in place after the operational failure was already known. The 1-for-90 split, the $50 million ATM offering activated immediately to exploit the temporary price headroom, and the explicit removal of the dilution ceiling through the authorization of 100 billion shares are not merely necessary survival tactics. They are aggressive, structural decisions that ensure the stock remains a vehicle for dilution and cash generation for the board, insulating management control while eliminating equity value.
And I reiterate that while that financial engineering is undeniably destructive, it is a predictable and, frankly, necessary response to the catastrophic deterioration of the core business. A company operating with a sub-1% gross margin and continually declining top-line revenue is fundamentally broken. The market's ultimate valuation is dictated by the unviability of the underlying operations. The financial mechanisms, the ATM, the reverse split, the massive authorization, are merely expediting the inevitable repricing from a company that has no organic path to profitability, cash flow, or sustained NASDAQ compliance. The structure is the method of decay, but the operational weakness is the reason for it.
It's clear that in complex, highly volatile microcaps like Quawo, the operational fundamentals and the structural maneuvers interact powerfully. It presents a terminal scenario defined by both the failing business model and the extreme self-serving measures taken to keep that failing model funded at the equity holder's ultimate expense.
Dissecting this case requires acknowledging both forces simultaneously. The core business weakness provides the overwhelming justification for the price decay, and the financial engineering provides the mechanism for its speed, its finality, and its extreme depth.
Right before ending, let me summarize our discussion. The advocate views the collapse as primarily driven by structural dilution mechanisms like the 1-for-90 reverse split and the $50 million ATM offering, which artificially cap the stock price. The dissenter emphasizes that the underlying cause is the operational failure, specifically the 30.2% revenue contraction and the catastrophic 83% drop in gross profit, which renders the financial engineering a necessary survival tactic. Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.